Jimmy, how you doing today?
Jeremy, I'm great. How are you?
Really good, thank you.
Good.
So we got another two fiduciaries here, and this week it sounds a little esoteric on the surface, but trust us, it's really not. It's market capitalization or equal weight, and
Yep.
what we're really talking about here is we're talking about index or indices,
Yep.
S&P 500 in particular,
Yep.
and we're going to go through and we're going to look at the difference between the market capitalization method
Yep.
and the equal weight method. And there's a lot of nuances there. It becomes kind of an interesting discussion point, but we think this is going to be a really fun episode.
I think this is really cool.
You've always been into this. I know you are very good at trying to explain this to people proactively. So I think this is a good opportunity to open up the doors and really talk about it.
I'm looking forward to it.
All right, so we just wanted to talk about the basics. What is market capitalization? Trying to give you a very simple idea of what this looks like. So you've got a stock, it has a share price of $10. If there are 500 million outstanding shares, do the math, multiplication, and you have a market capitalization for that company of $5 billion, right?
Right, exactly. So when we think about indices like the S&P 500, or maybe smaller companies like the Russell 2000, they're based on the market capitalization of the companies that make up those indices. And so, a $5 billion market cap company would, be on the smaller end, really, it'd be a very small constituent of the large cap benchmark. So yes, this is an easy way to understand, though. It's simply said as the share price multiplied by the amount of shares outstanding. That is the market capitalization. This company's share price went up, $20, then you'd have a $10 billion
Right.
Market capitalization.
Right. Got it. Okay. So now you apply that concept and you apply it to an index like the S&P 500, and your standard mode for the S&P 500 is it's market cap weighted.
Right, exactly. So what that means is like it is literally holding each stock is moving as its market capitalization moves, and the percentage of the index that it makes up is based on its market capitalization. So the larger the company, the better the performance, the larger percentage it's going to be as a constituent of that index, as opposed to like what you're seeing with the equal weighted, where it's just as it looks here
Yeah.
and as it sounds, they're equally weighting this
500
across the board.
equal parts.
There we go.
That's what it is. But in fact, the way it's designed is 500 unequal parts.
Correct.
And that's what's making up the index.
Exactly right.
So here's a snapshot. We just took this off of our software, our charting software today.
Yep.
And these are the five, I don't know, close to the top 10 here, I guess, of your constituents within the S&P 500 and their weight on the right-hand side.
Correct. So that weighting is going to continue to move every single day as the stock price of each of these stocks and all of the stocks beneath them in the 500 constituents of the S&P 500, the weighting of the overall index in this cap weighted index is going to continue to move on a daily basis. So what we see here is, as you'd expect to see, a lot of the Magnificent Seven stocks are the top holdings in the S&P 500. Microsoft being the largest at over 7%, and you still have Apple and Nvidia both also holding percentages over 5% or allocations over 5% to the index. So when you look at how the S&P 500 is moving, you need to start thinking about, well, what are the biggest drivers of making the S&P 500 cap weighted index move? Well, these big ones are the ones that are having the majority of the movement of the overall index.
Right. Well put. And I like to think about this in terms of dollars.
Yeah.
You take $100, you invest it into the S&P 500
That's
today.
right.
What are you getting? I have $7 is going to be in Microsoft.
That's very well put.
$1 is going to be in Tesla.
Exactly right.
So that's kind of what you're looking at right there. And again, that it's a moving target.
Yep. Well
It
said.
constantly changes. And some of the things that I think are interesting just of note, real quick, is that a lot of people have remembered Apple as being the top dog in the S&P 500 for many, many years now.
Right.
And
Yeah.
in fact, it's not. Microsoft overtook them. It was just a number of months ago.
Right. Well, as I'm sure we're going to see in a slide or two here, Apple has not been performing very well here in 2024. Certainly not compared to the S&P 500. Cap weighted or equal weighted performance has been year to date, and it's definitely not holding up as well as it has against the other constituents of the Magnificent Seven.
Got it. Right. Absolutely. And again, just to take this whole thing a step further, if this were equal weighted, right, each of these would be the same.
Yep,
They'd have the same
exactly.
percentage.
Right.
All right. So we talked about the Magnificent Seven. Let's talk about who those stocks are real quick. And they get a lot of attention. They've gotten a lot of attention. In 2023, we were giving a lot of credence to the Mag 7 because these companies were driving a lot of the growth within the S&P 500 and the broader market.
Yep, absolutely. And these stocks, it's important to know that the Magnificent Seven term, that thing has evolved over time, right? Because the first thing it was FANG.
Yep.
Right, so it was like your Facebook, your Amazon, Netflix, Google, right? Like those were the FANGs, and then it was FANMAG, and then it was the Magnificent Seven, and now, because as you can see in the chart here, Tesla has had a very poor year, it being the worst performing. This performance on the chart here is year to date. So this is 2024 performance. You can see Tesla's not been a very good position to hold in 2024.
Not at all.
Up to this point. That's not speaking anything to what it has been or what it might be, but just in this snapshot of time, it's not been doing very well. So now you're starting to have some people call it the Magnificent Six. So the names and the acronyms that are going to be used for the top holdings and the index are going to continue to change and evolve. But this is where we're at today.
Absolutely. I heard somebody talking about it's the Fabulous Five now because, Apple and Tesla have fallen out of it. Well, okay, I get it. Now, if you were to take this same chart and you were to look at it over a 5-year span, it's different,
right?
Naturally, right? In fact, Nvidia still reigns supreme,
right?
But who comes in second is actually Tesla. But they've had a tough time of late. So here's what it looks like, guys. The other thing I'd want to note in here is it's sort of a brown goldish kind of color in here. That's the Spider S&P 500.
Right.
That's kind of right in the middle there. 10% return. So that is the pure market capitalization style ETF for the S&P 500.
Yep.
All right. So now we've got a JP Morgan slide here that looks at the performance of the Magnificent Seven in the context of the S&P 500. It extracts those those 7 stocks and takes the rest of the 493. I think it's actually 496 stocks because there's 503 in total.
Right.
But you guys get the point. And you're looking at that here in this first on the left-hand side, the box at the top of the chart there. Let's take a look at the year-to-date 2024. Magnificent 7 up 13%.
Right.
S&P 500 X Mag 7 6%, and just the straight S&P 500 10%.
Right. So there's not you can see obviously the importance of the Mag 7, but most notably, as we saw in the previous slide, Nvidia has continued to be a rocket ship of a stock and just providing incredible returns. But you also, I think what I hope will be impressed upon folks is the importance of diversification and how having that risk spread over all 500 or 503 companies, you're still getting a really darn good return year to date. 10%.
Right.
Without having to take that concentrated risk is pretty darn good.
Now contrast that to the 2023 look there. The Mag 7 was 76%.
Yep.
Compared to 8% for the rest of the S&P 500.
It literally was a reversal of 22 though, right? Because when you think back to 22, a lot of these stocks
was down 40 and then the others were down 8. So
exactly. So it's again, it's important to understand what you own and what's underneath the hood of some of these benchmarks and indices and different investment strategies.
No doubt about it. And now the earnings growth piece here to the right, I think is also just relevant to talk about. Again, this is the upper chart here on the right-hand side. After that dotted line, you're talking about the forecast here for Q1 through Q4 of 2024.
Yep.
Well, What I want us to see is the trend.
Yeah.
And the trend looks like the S&P 500X Mag 7 is it's growing, right?
Right.
The
Yeah.
earnings pieces are catching up, and in fact, forecasted Q4 going to do better than the Magnificent Seven.
Well, yeah, you look at the blue bars and they continue to have an upward trend there, and the green is sort of a downward sloping trend, right? So this isn't to say that we are making any calls or projections on projected investment returns for these stocks, but it's certainly an important factor to consider when you're thinking about what you own and what's underneath the hood.
It's a broadening of the market at very least, right?
Sure.
So, you can say there's more participants now in the upside of this current bull rally.
Yeah.
So I think, and I think if you really look at a lot of, experts in the space, what are they going to tell you based on that information alone? That's a strong sign, right?
Absolutely.
That means even though we are making new highs with some regularity here in 2024, you're going to have a situation where there's a pretty good confidence that it can keep going.
Sure.
There's no crystal balls. Just, always,
Right.
That's the caveat.
But again, you think about looking back 22, the tech was very much out of favor. 23 was very much in favor. Year to date, tech as a sector as a whole, not so much. It's being really carried by some of the bigger names. But you have absolutely seen where an equal weighted index would be performing well, because you've had sectors like industrials and financials really sort of providing some more performance this year, that it is a broadening of the market. It isn't being so much carried and dragged along by those top Magnificent Seven stocks.
People get nervous because, when you have certain stocks just ballooning to the top. I mean, of course, Nvidia is one of those ones where people keep predicting its demise and
Sure.
its bubble to burst.
Yep.
Right. It keeps beating expectations miraculously, but it is those types of things that gets the investor class nervous.
Sure.
The broadening out of this is again, I really think that's an important part of the psychology here, is that you're seeing some broad-based returns, and I think that's a positive thing.
Yes.
Okay, now we've got a bigger time horizon here. We're going all the way back to 1990. For those people who listen to Fiduciaries and watch these videos, we've done something like this from a trend line perspective on the international market compared to the domestic market.
Right. Yep.
Here, what we're looking at is the S&P 500, the market cap weighted versus the equal cap weighted, and so in green, you're seeing where it's the market cap,
Yep.
and in the kind of grayish color there, you're seeing the equal weight. So again, things change.
Drastically, right? I mean, it looks like, my takeaways from this when I look at this is that the darkish gray, their outperformance has been substantially higher when it has been outperforming. The highest peaks there. And again, it just speaks to the cyclical nature of markets, right? And sky, what is the trees don't grow to the sky type thing. I mean, at some point in time, there will be disruptions in the market, disruptions amongst with competition in the markets between the different companies and the stocks. And so this is why it's really important to be diversified in your portfolio and having a well managed and balanced portfolio.
No doubt about it. And then the other thing of note here is just, looking at the top table within the chart itself, share of periods outperforming. So the equal weight has got the edge.
Yep.
At 53% compared to 47%. Naturally, the equal weight has also got a better PE ratio on it. So because of the nature of some of these smaller companies that aren't trading at higher multiples,
Right.
You're buying into a little bit more value orientation than you would be just a pure growth orientation. Again, this is all relative. It's all within the S&P 500. So don't get me wrong. It's a growth model, right? It's a growth index.
Right.
But you do have variance in there.
And listen, at some point in time, the price that you pay matters, right? And you don't know when that is, because momentum is a very impactful and well recognized variable within investing. And when the momentum's on the market cap weighted side, it can be very good.
Yep.
And then when it's not, then it absolutely is turning against it. So I think it is important to point out though that the equal weight, you're going to have a lot more weighting to those smaller companies that may or may not be, depending on the period of time that we're looking at, a good thing to have that allocation.
Right. And they could also, the argument on the flip side of that could be, look, I want to take advantage of company 450 in the S&P 500 because at some point they might be a top 5.
Right.
And companies don't typically go from, 1,000 to 1.
Right.
Right. There's sort of a growth period now.
Right.
Now we were talking about this the other day, not to get off on too many tangents, but I mean, a lot of IPO companies nowadays are coming in at a pretty large number, right? So they can kind of find themselves into that large cap space.
Right.
But even still, right? I mean, let's just talk about this traditionally. There's sort of a growth range that you start at smaller, you get bigger. That's just the way it works.
That's exactly right. And now, again, we don't have this on any slides here, but you're thinking about, what were the top 10 companies in the S&P 500 20 years ago.
Different.
They're not the same companies that are the top 10 today.
Right.
And so one of the beauties of a market cap weighted index is allowing the winners and losers to sort of shuffle themselves out without you having to predict and identify who are going to be the big winners, 5-10 years from now. It's impossible to know who those are going to be right now. Right.
Right.
We had such an AI boom last year. That was really what we seem to be thinking is driving the market with the tech stuff last year. And rightfully so. These companies had great earnings with the technology, but they're still, if we were to look, if we had a crystal ball 5 years from now, are those same companies that are the top 10 now going to still be in the top 10? I would say more likely no than yes.
Right.
And look, there's probably plenty of other companies underneath that top 10 that are going to figure out how to utilize this technology and profit very nicely off of it. So it's just one of the reasons why having a diversified indexed investment like an S&P 500 is so often a very good position to have in a portfolio.
So you're speaking some true, I call it some true value in talking about what it is that the S&P 500 does for you. So the market cap versus the equal weight. You were just talking about this. The momentum piece can
Right.
give you that real nice shot in the arm that goes straight up, right?
Yeah.
Likewise, it can go the opposite direction, right?
Yeah.
And then we talked about it as well, the value piece associated with being in an equal weight kind of environment.
Right.
I would tell you, giving my 2 cents on it, I think if you're looking for value within the S&P 500, you might actually be looking in the wrong spot. There's value within it. There's
Sure.
no doubt about that.
Right.
Right. But maybe there's a better way to do that than just through an index. Maybe that's a money manager that's going and looking at the fundamentals on these things.
Right.
And picking and choosing the right ones.
Right. Absolutely.
I think that might be the better play if you're just strictly looking for value, right?
No, absolutely. I mean, think about you. I like the way we've got this sort of lined up here with momentum and concentration and blue chip all for the market cap.
Yeah.
Now, think about it this year. We've mentioned NVIDIA a couple of times, and it has been like the hottest stock for a decent amount of time now. Who knew that NVIDIA 5 years ago was going to make up 5% of the S&P 500?
No way. I mean,
right? And
yeah.
if you don't have a 5% weighting to that, think about how much you potentially missed out on that return. But predicting who was going to have that performance and be that successful was impossible 5 years ago.
I mean, if anybody's telling you that story, I think wait till they tell you another one, because
Right.
it's just I don't think people saw it coming. Not to this rapid of a pace
Right.
and what they've been able to do.
Right.
It's amazing,
Yes.
right? So there is this concentration piece. You can get over concentrated if you're just in an S&P 500 market capitalization weighted, and you can get over your ski tips a little bit with some companies, right? And so that speaks to what we talk about is rebalancing one's account with some level of rigor and regularity.
Yeah, and having a discipline to do that, right?
Yeah, right.
Like having processes and controls in place to know when is the right time to trim and when is the right time to continue to ride the wave. It's all relative, and it needs to be done under the context of the confines of a big financial plan. But yeah, I mean, again, the concentration of these stocks can be a very good thing for you until it's not. So momentum and concentration are your friends until they're not, and then you want more value and more balance.
Exactly. And then there's this blue chip versus smaller chips. What are we saying here? We're saying that the blue chips are these sort of the blue blood companies that are really well diversified. They're very strong balance sheets. They're not going away with, you know, uh, during a hurricane. I mean, they are going to withstand a
Right.
lot of different pressure that the market could place upon them and still come out on relatively on top.
Right. Absolutely.
You know, that's who they are. Some of these other companies, I mean, look, to your point earlier, they change, right? I mean, not everything in the S&P 500 is static, not
Right.
by any degree. And some of these, smaller size companies within the S&P 500, I don't know that you want to have as big of an allocation to them as beyond what the kind of the natural market cap weighting would provide you. That's my personal take on
Well,
it.
I would totally agree with you. I mean, I think there are some smaller chip companies that are on their way to becoming no chip companies,
Yep.
and then there are some that are in the smaller chip category that are going to become blue chips.
Yep.
And again, I think that was the point you were making earlier, and I totally agree with it. Is that's where having a money manager who's doing the fundamental research on those companies can really benefit an investor to be picking the right ones, those smaller chips that you want to have, and avoiding some of the ones that you might not.
No doubt. Listen, we could talk all day about this because it's such an exciting topic, and it's sort of in the weeds, but it's
Yeah.
it's really right there for everybody. So it's important to understand this. We think as investors, if you're going to be invested in the S&P 500, you should understand how it works.
Right.
And this is fundamental to that. Likewise, there's been a little bit of a charge I'd call it in the last 6 months or so with people saying, hey, what about equal weight?
Right.
And there's nothing wrong with looking at that. It's just you want to do your analysis
Yeah.
and figure out what works best for you and your portfolio.
Absolutely.
Well, that's all we have for today.
That was fun.
Yeah, thanks so much. And until next time, everybody, if you need anything, reach out to us at On Track Wealth Management, and we'll see you next time.